Hey, Scott. Good to see you this morning. We're here today to talk a little bit about 401ks and retirement savings. You and I both agree, I think, that the 401k plan is the most prevalent method for Americans to save for retirement. The employer-sponsored retirement plan, and I think for the sake of our conversation today, we could expand that to include 403b plans. Do you agree?
I absolutely agree, Dan.
Yeah. Well, there are some nuances there. I think everything we're going to talk about today does apply to 403b plans. So specifically, what we want to address today is what are the options that people have when they separate from an employer, whether they're laid off or they find a new job, a better job opportunity. What are the options that they have with their old 401k or 403b plans left at that former employer?
Yeah, sure, Dan. So I'd say the first option is leave the funds where they are, where they reside. So at the old employer plan. I'd say the second option is to roll them to your current or new employer's plan.
Okay.
And then your third option would be to roll that money, typically tax-free and penalty-free, if done correctly, into your own IRA, your own individual retirement account.
Okay. Okay. Well, why don't we dig in on those options a little bit, and talk about talk about those in greater detail, and why not? Let's just start with the first one, leaving funds in the current 401k plan. What would you say are the pros and cons of doing so, leaving the money there at the old plan?
I think it's just ease. It's easy just to leave it, and sort of forget about it. And I think that's the primary advantage to leaving at the old employer plan. Just it's easy to do, and you're not forced out. There's
Yeah.
situations or things called de minimis IRA. So if your balance falls below a certain threshold,
Yeah.
often the plan at the end of the year will sort of kick you out and cut a check.
Yeah.
Then it's your responsibility. But let's say for balances above that threshold, which typically somewhere around $5,000, maybe it's 10,000. You can leave your balance in the plan, and
Yeah.
it's just easy to
So
do
it's
that.
just that I don't have to do anything. Out of sight, out of mind.
Yeah,
Which I think probably is also a great segue into the cons of leaving it with
yeah,
your old plan.
yeah. And I would say, in some respect, Dan, that's sort of a lazy option, if I'm being 100% honest. But yeah, it's sort of the ease of doing it. And the drawback is you're not there. So by law, they're going to have to continue to send you quarterly statements, and that's part of, retirement ERISA law. So it's not that you won't get your quarterly statements. But the drawback is, how much attention are you going to pay to it? We
Right.
often call them orphan accounts, or you've got an orphan 401k, and sort of out of sight, out of mind is the way I look at it. Like, you're
Yeah.
not there. The rest of your benefits, as you look at your benefits, don't your current benefits when you go to your new employer aren't back at your old employer.
Yeah.
And so
Yeah.
I have a hard time wrapping my mind around why people do that, but we see it all the time.
Yeah.
And I think it's just simply because you're allowed to, and that's the sort of end of story.
Yeah. Yeah. And I mean, I've had situations, Scott, where I've had clients that, when we first start working together and they bring me all of their stuff, that come in with this look of delight on their face. And it's like they've got a secret in their pocket that they're about ready to reveal. And that receipt
Yeah.
is like, hey, Dan, guess what I found?
Right,
I found $20,000 in
right.
my old 401k that I forgot about that, was 3 employers ago. And it was just exactly that. It was out of sight, out of mind, and I had completely forgotten about it. But that's another $20,000. Like, I get excited, Scott, if I find a $20 bill in the dryer. But
Well,
find
yeah,
twenty
I do
thousand
too.
dollars,
Yeah,
So
yeah.
they're but those things have happened. I've seen it.
But
Or you have too.
it happens all the time. I
Yeah,
mean,
all the
when
time.
they when a client comes to work with us and we sort of force them to through their what we call their financial junk drawer, I'd
Yeah,
say we see it, I don't know, 6, 7 out of 10 times. I mean,
yeah.
like it's pretty regular.
Now, another thing I think is, we might as well broach the subject now. Uh,
Yep.
what what about investment options and fees? Let's talk about that for a second. So, investment options in a 401k plan.
Mhm.
Um, my experience, you tell me if you disagree, but my experience is that most 401k plans, at the end of the day, when you weigh the really, really good investment choices that are in there against the ones that are kind of the dogs of the plan, in
Yeah,
at the end, you end up with a mix that is middle of the road, if you
yeah.
will. That's
I think
maybe saying it kindly, is middle of the road in terms of the investment choices. Again, there may be one or two in there that are really great funds,
yep.
um, but there also may be some dogs. Um,
Yeah.
but I'd also add to that in 401k plans, it is a limited menu. You usually, I find, 10 to 20 different investment choices are offered. Um,
Yeah, I would say 10 to 20 on individual funds, and then they have their lineup of, the QDIA or what we refer to as the target date funds.
right. Yep.
Yep.
Exactly. Exactly. And then, going on the other subject that I just brought up, which is fees.
Mhm.
You know, I think that there is a little bit of a myth out there that we could bust here today. The myth is that 401k plans are inexpensive investments. And why I say that's a myth is that I think that can be the case. Some
Mhm.
401ks are inexpensive investment platforms.
Yeah.
However, it's not always, everything isn't always what meets the eye. In other words, um, most 401k plans that I've encountered do have some form of an underlying asset based charge
Mhm.
that is not reflected on your account statement generally. It's not right there out in the open for everyone to see. It's for lack of better term, what I would call a hidden expense of 401k plans that um, you don't see. And so I think it's a bit of a myth that 401k plans are the cheapest way to invest your money for retirement purposes. Would you agree with that?
I would agree with that. Yeah, it's definitely not a foregone conclusion that, 10 times out of 10, that a 401k plan is less expensive than an IRA, for example.
Yeah, yeah,
Yep.
great. Well, so let's move on to the second option that a person should consider when they have a former employer 401k plan, and that is to take those funds and roll those 401k dollars into their new 401k plan. What would you think of when you consider that option, Scott? What would you think would be some of the advantages of doing that?
Yeah, I think one of the main ones is if your new employer plan has a loan provision.
Hmm.
Um,
Yeah.
and to me, that's one of the biggest advantages because in an old 401k that you're no longer an active employee at, you can't take a loan. Okay.
Yeah.
But in a new plan where you have payroll, you have wages, salary coming out, if the 401k allows it in their provisions in the plan document, you could have a loan provision. And to me, that's an advantage of having your money in your new
Yeah.
employer plan if you needed to get at those dollars.
Now I'm going to put you on the spot here, Scott.
Yep.
In general, I mean, we're speaking in generalities here. What's your
Mhm.
opinion about borrowing from your 401k?
Yeah, I mean, that's not a great idea in general.
Right.
In general, yep. I'm glad
Probably
it's
shouldn't be your first option,
first.
right?
Yeah, shouldn't be your first option. Correct.
Yeah. Yeah.
Correct. But to me, that
Agreed.
is a, and I led with it being an advantage. And so, yeah, good call on sort of calling me out there.
Yeah.
But
But
to me,
there are
that,
circumstances where that might make sense to do
right,
that. And you're right in saying that the other two options, the keeping it in your old plan, that option is no longer available once you've left the company. Loans are
correct.
not allowed. And
Because maybe we want to touch on why.
yeah,
It's
sure.
because when you pay that loan back, yes, you're paying it back to yourself or to the plan. Um, and it's got to be done through payroll contributions.
Right.
And that's why. So,
Right. And then the third option, which we're not going to dive into quite yet, we'll get there in a moment. But the third option being a direct rollover to an IRA account, also does not have. There are no provisions for loans on IRA accounts as well.
correct.
So if you think you may need to borrow against that money at some point in the future, something that we generally don't advise. But
Right.
if you think that may be something that you would need, then maybe rolling that money over to your new employer's plan, that might be a reason to do that. Yeah.
Yep.
Um, Disadvantages of transferring funds to a new plan. I guess I would say we've already kind of talked about this when we talked about the first option of leaving it in your old plan, which is that 401k plan in general, and we're speaking in generalities here, tends to have a menu of options that may be 10 or 20 deep of investment choices
Mhm.
that at the end of the day is middle of the road. Maybe not the best, maybe not the worst. You might have one or two options in there that are good, and you may have one or two options in there that are complete dogs. What you're not going to have in the new plan is specialty investments generally. You're not going to have real estate, for example, as an investment option in most 401k plans, or let's say buffered investments that provide some protection against market free falls. Precious metals is often an asset class that is excluded in the fund selection process for 401k plans. They don't generally include some of these more niche asset classes in them. Um,
Mhm.
any other disadvantages that you would list?
The rolling money into the new employer plan.
Yeah,
No, I mean, I think it's, control and a narrow breadth of, or limited scope of investment options are the primary.
yeah,
I would say an advantage is it's your current plan and most of your other benefits, health insurance, maybe disability insurance, group disability, is there with your current employer. And so I think, one of those being, retirement makes some sense, or is an advantage to having it all there in one place.
yeah, yeah, absolutely. I just thought of another myth we could bust here, Scott. I'm
Okay.
changing the subject a little bit, but
Yep.
um, the myth is that if I have all of my money in the same account, that I'll make more money.
Yeah.
That my
Right.
rate of return will result in a greater dollar value at the end of the year.
Yeah.
And I know you've gotten that for from
I, I
people who
have.
above average intelligence, and I get it
And,
from time to time as well.
and people with, advanced degrees. And
Yeah,
this is not complicated math, let me say.
right.
Yeah.
Yeah, we've seen
Uh,
it. We've seen it before, And we're all things being equal, a 10% return on 100,000 is $10,000, whether that is spread across 10 accounts or it's all centralized into one.
Yeah, that one always shocks me a little bit when that comes up and people have a hard time grasping that concept.
Yeah, me as well. But
It
uh,
happens.
let's consider that myth busted. All
Yeah.
right. Great. Well, I think that we've covered the first two options pretty well.
Mhm.
Before we jump into the third, anything else to add there?
When I said a primary advantage is, having it all with your current employer with your other benefits, that you're making contributions to it. You know, I think, that's an advantage.
Sure.
And it, like I said, it's all in one place. You're making contributions. And so for people who want to keep things nice and tidy and simplistic, that's probably the main
There
advantage.
you go. There you go. Yeah, very well. Well, the third option is to take the former uh, 401k, 403b plan and perform a direct rollover into an IRA. As you indicated in the early part of our conversation here, that is a tax-free maneuver because we're assuming that you're taking pre-tax money from the 401k and you are performing that direct rollover into a pre-tax IRA, or potentially you are taking post-tax Roth 401k contributions and rolling those through the direct rollover to a Roth IRA. Both of
And
those scenarios are tax neutral.
Dan, I'm just going to interject because there was a word that you were using, I think deserves some further attention. And
Sure.
you were saying direct. And so I'm going to define that for our audience. And direct means when you request the check is made payable to the new IRA custodian, not to you, Dan Grote. Okay.
That's absolutely correct.
So the check is made payable to XYZ IRA custodian, FBO, for the benefit of Dan Grote, as opposed to a 60-day rollover would be something like the check is made to Dan Grote, not made to the custodian. Okay. And then it's Dan's responsibility once he takes receipt of that check is to get that check into an IRA within 60 days. Otherwise, it's a taxable event.
That's right.
And so I want to make that distinction and further clarify what direct means.
That's right. Very good. Very good. Yeah, absolutely. Important difference there in those two actions. But for the purpose of our conversation, we're talking about a direct rollover into an IRA. Benefits of doing that. I would throw out one is that this IRA account can become somewhat of a consolidation or a holding vessel for future 401k dollars to be consolidated together and invested in a more maybe customized fashion to what your individual or family needs may be for retirement purposes.
Yeah, I would agree with that. Most definitely.
Yeah. We talked already in the prior two options about the the cons of the 401k plan being a limited investment menu. Uh,
Mhm.
within an individual retirement account, virtually all options are on the table, depending on the dollar amount that you have, right?
Right.
That you have in the account. In other words, there are certain investment vehicles that may have asset minimums in order to access, and that may start at 10,000, 25, 50,000, or even 100,000 for certain investment vehicles. But
Mhm.
but in general, an individual retirement account is going to open up the whole world of investment choices to you.
Yep.
Now, it's it, I will be, to be fair, I'm going to bring up the Cheesecake Factory into our conversation because, well, number one, I
Good
love
exa-
cheesecake.
yeah, it's a good example, man.
But for anyone who has ever gone to the Cheesecake Factory, you know that their menu is bound. Okay, it's got
Yes.
to have 10 or 15 pages to it of different choices of what you can pick and choose from, whether you're just going for cheesecake or you're going for dinner. Um, and for the person who's doing it themselves, that could potentially be overwhelming.
Yeah.
Um, but
Sure.
in general, the IRA account, while you have the whole world available to you, what it also opens up to you is the ability to have a financial advisor on your account and somebody who is there to guide you to the right options. Am
Mhm.
I am I
We're on the
is
same page.
that
Yep.
clear? On the same page there? So I
Exactly.
put that in the pro column that you have that, almost unlimited investment option within the individual retirement account uh, for the direct rollover. Um, I think that while we're talking about potential advantages of professional guidance, I think it might be a good time for me to share a couple of things here.
Yeah.
Yeah, I
I
want to
think
talk about
a couple of the studies that are,
yeah, that's right. I want to talk a little bit about the Dalbar study. Um, they've been doing this study. Dalbar has going back to 1984, and what they're looking at is the 30-year history of what the performance has been for the average equity fund investor. This is the most recent version that we're looking at here on the screen. And what we see is that going back to 1993, the average equity fund investor has earned 6.81% rate of return. I think the relevance of that is when you compare that to what the US stock market has done over that same time period, which is 9.65%. Roughly 3% difference there, Scott.
yep.
And you and I have both been doing this now for over 20 years. So
Yeah.
we've been looking at this Dalbar study, the 30-year history of the average equity fund investor.
Hmm.
And over our career, it's always been a roughly 3% spread between the market and what the market has done and what the average equity fund investor has done. What do you chalk it up to?
Yeah. I chalked it up to, uh, financial behavior or human behavior.
Yeah.
And diving a little bit more specific on people, chasing returns, um, getting scared when the market goes through its cycles, meaning, an expansion or appreciation in the market, and when it goes through a contraction. And that's economic contractions and market contractions. And they don't directly overlap, but they often follow each other. And people will bail or sell out specifically of the market when we go through contractions, and we see it all the time. Or you know I say sort of goofy stuff like we potentially face this year with a presidential election. People will make poor decisions that, depending on the outcome of the election, they believe that the market's going to either contract or appreciate based on this decision alone. So in the case that we're talking about the S&P 500, we're talking about 500 companies, and that all of a sudden 500 companies and all their employees and their CEO and their board are going to simultaneously decline due to the November outcome of the presidential election. And it it amazes me that we see it, every 4 years. But happens without, without skipping a beat. I mean, we see it.
Yeah, you and me both. The most basic tenet of investing, the most basic principle of for investing is to buy low and sell high. And yet when people do what you're describing and panicking when the market goes through a contraction, they're doing exactly the opposite of that. They're instead of buying low, they're selling low, and that's certainly no formula for investment success. We know that to be true. Yeah, absolutely. I love also, just to quote our friend Dave Ramsey, the only people that get killed on roller coasters are those that get off in the middle of the ride.
That's great. Yeah, I love it. That's a great example. Yeah.
I'm going to flip over for a moment here and just talk for a moment about another benefit of doing a direct rollover. And I think this is where maybe it gets specific to working with a financial professional.
Yep.
That is in the realm of customization. We've talked a little bit about this already, but let's face it, people's lives are becoming more and more complicated, and each person has their own set of personal goals, circumstances, and preferences. And a financial advisor who has an in-depth knowledge of their client's individual situation can provide significant value. There's no denying that. The customized experience for the client and comprehensive financial planning that a financial advisor can provide, it could be immeasurable to guiding their client and their family through major life events and decisions. Looking at a study, this is a study here, Scott, that you and I again are very familiar with, from Vanguard Investments of all companies. And the reason I say that is that Vanguard, as you know, is a company, an investment firm that has built its name on supporting the do-it-yourself investor. And yet, when they study it themselves, what is the value of adding a financial advisor to the picture? The number that they come to is about 3% in net returns, depending on what the deliverables are that financial advisor brings to the table. Okay. And so with that being said, that I think is the pitch to the third option that people should consider with their old 401k money in terms of whether they should roll that to an individual retirement account. We have built a customer-focused practice, a customer-focused firm at Latitude Financial Group that is all about getting to know our clients and helping them to achieve the competing goals that they have in their lives. And I say competing goals, I mean goals that are competing against one another, like saving for their children's college, simultaneous to accumulating enough wealth that they can stop working for the rest of their lives, at the same time as perhaps preparing for a family member, a parent, grandparent, aunt, or an uncle who may need long-term care services in their lifetime. It's those kinds of complicated, diverse, and competing goals that we help clients to navigate every single day. So I think that the customization options that we bring to the table in terms of the individual retirement accounts. Scott, I've got a client that I helped. She was an engineer in the oil and gas business years ago, And when she left the big company that she had worked for, we rolled her 401k plan over through a direct rollover to an IRA account, where we were able to get her some exposure to real estate through a real estate investment trust. We were able to take a portion of her equity allocation that is designed for long-term growth and add a buffer to it, that if equity markets decline, that she's not on the hook for the first 10% of those market declines. Now that particular position also does have a cap associated with it, as is true for those types of buffered strategies.
There's no free lunch, right, Dan?
No free lunch, right? But
Right.
for a portion of her equity allocation, that made sense to do. And then thirdly, we're able to access precious metals, gold, silver, platinum. You mentioned earlier, I think, mining companies, mining stocks, for a portion of her retirement dollars. These are investment options that just aren't available in a 401k plan. At least I have yet to see it. So,
yeah, me either, Dan.
Well, listen, I think we're at a pretty good place to start to wrap this up. Do you want to just talk one more time through what those three options are?
Yeah, I think the three options you consider are, sort of take the lazy option and leave it as is because it's easy.
That's right.
Option two would be to move it to your new employer plan. I'd say there's two main advantages there to the new employer plan. One, it's your current benefit and you're contributing to it. And then two, a potential loan provision. And then three, rolling it over to your own IRA and working with a professional and an advisor. And that gives you a broader array of investment options, more control. And we've seen several studies that Dan pointed out, talks about the benefits. These studies have been done a long time from qualified organizations. And, the reason you'd work with an advisor are those, and if you don't have the time, interest, inclination, but you recognize the importance of it, is what I would add to that.
Absolutely. Yeah, I would just encourage anybody who's watching this video right now to make an informed decision based on your own financial goals and your own personal needs, and extend the invitation to reach out to us. We do offer a 1-hour complimentary consultation that we can sit down and talk through your own unique set of circumstances and what your goals are and help you with those kinds of decisions. If you're wondering how to get a hold of us, you can check us out on the web. We're at www.latitudefinancialgroup.com. Our email address is info@latitudefinancialgroup.com, or you can reach me at 720-881-8744, or Scott.
Yep, at 720-881-8742.
Great. Awesome. Just encourage you to take the next step forward as far as securing your financial future. Make those informed and educated decisions regarding your retirement savings. You might think that it's only $5,000 or $10,000 in that old company plan, but look, you wouldn't look at it that way if you found it in the dryer, right?
Right.
Just want to take the last second here to thank everybody for their time and attention to this video. Give us a thumbs up if you liked it. Share it with anybody that you think it might be appropriate for, and have a great day. Hey, everybody. Dan and Scott again. Just a quick addendum to the video you just watched. Thanks for hanging in there with us. In this addendum, we want to talk about a fourth option with regard to your old 401k, and that is the cash out option. We didn't discuss it in the prior video footage because, frankly, it is probably the least appealing alternative of what you could do with your old 401k plan. Apart from very unique circumstances, it's just not a very good option. Scott, you want to talk a little bit about what some of the implications might be for somebody that does choose to take that cash out option on their old 401k plan?
Yeah. First, if you're under 59 and a half, you're going to have a a penalty for distributing pre-retirement distribution. So under age 59 and a half, you've got a 10% penalty there. You're going to have to add state income taxes to that distribution check, that cash out. Here in Colorado, that's 4.625. We usually just round it, call it 5%. It's a flat state income tax here, but you may be in a state that resides that has a flat or a graduated income tax, could be more or less than what we are here in Colorado. And then you've got the big one, the federal income tax. So you have to add that to your income that year. And so, those would be at your highest marginal rate for you individually. And so, if you have a salary and wages of 50,000 and you're cashing out an IRA or a 401k, excuse me, at 50,000, now your total income for the year is at 100,000. Or if you're at $100,000 salary, just keeping the math simple, and you're cashing out a $50,000 401k, now it's 150,000. So, not uncommon. You may be at, 20-25% federal income tax. So you're going to lose, somewhere probably in the order of 35 to 45 cents on the dollar, just in taxes and penalties, let alone that future interest, that future compounding interest on those dollars, which could be, 5 years from retirement, could be multiple decades, depending on how old you are when you take this distribution, and then versus how old you are when you use the money in retirement. You're going to lose out on thousands of dollars, more than likely, of compounding interest.
Yeah, I think we've kind of covered the gambit there, Scott. Is there anything else that you'd add to that conversation?
No, I think it's of the four that now that we've discussed, I think it's the one I like the least for sure, and that's why we kind of listed it this way as the last one, just because we think you got to think long and hard about making this decision, because there's the obvious and right away penalties, and then to some extent the penalty of the lost future compounding interest, and sort of the harm or damage you're doing to your future self by making this decision. So
that's exactly right. Yeah, that's exactly right. So we hope that you guys found this video to be informative and helpful. If you have any questions, again, check us out on the web at www.latitudefinancialgroup.com. Email is info@latitudefinancialgroup.com. And if you back the video up a little earlier, you'll hear you'll see both of our phone numbers listed there. We'd be happy to help with any of your questions that you have. We do offer a 1-hour complimentary consultation. But with that being said, Scott, I think that's a wrap for us for today.
All right, terrific. Thanks, Dan.
All right, everybody have a great day.